Hi there, this is Mike Kramer of Mott Capital. Today is Tuesday, March 5th, and it's around 6 p.m. New York time. We're going to be entering a very, very busy part of the economic calendar week. Also, we're going to have Jay Powell testifying in front of Congress, and we're also going to be getting an ECB rate announcement on Thursday. Tomorrow morning, we're going to start off at 8:15 with ADP employment. We're looking for 150,000 jobs to have been created in the month of February, up from 107,000 last month. Then at 10 a.m., we're going to be getting the JOLTS job opening report. We're looking for the number of job openings to decline to 8.8 million from 9 million last month. Again, this is a number that can see large revisions. It can also be a very hard number to predict. So I would be watching this one closely, and it also tends to be a market mover at times. Then on Thursday, we're going to be looking for initial jobless claims, 217,000 versus last week's 215,000. Continuing claims, we're looking for 1.88 million, down from last week's 1.9 million. Then on Friday, we're looking for the big job report here in the U.S. We're looking for non-farm payroll of 200,000, down from 353,000 last month. The unemployment rate's expected to stay unchanged at 3.7%. Average hourly earnings are expected to increase by 0.2%, down from 0.6%. Average hourly earnings year over year expected to be 4.3%, down from 4.5%. Then the labor force participation rate is expected to rise to 62.6% from 62.5%. Additionally, you're going to be Fed Chairman Jay Powell speaking in front of Congress starting tomorrow at 10 a.m. He'll also be speaking again on Thursday at 10 a.m. as well. So 2 days of testimony by Jay Powell will certainly be something to be listening to and paying attention to. And then, of course, on Thursday morning, also, you're going to be getting the ECB rate decision. Expectations are for the ECB to basically be doing nothing and sitting on their hands, at least for this meeting and next meeting, with the odds building for a potential rate cut at the June meeting. Right now, we're pricing at about 93% chance for the first rate cut to come in June. And so obviously everyone's going to be listening very closely to that press conference and Christine Lagarde and what she has to say about the potential for rate cuts and the timing around those rate cuts. And obviously, you know, the ECB rate decision will have a lot of impact on the euro versus the dollar specifically, especially if she comes in more dovish than expected, or it could even work the opposite way, where Powell perhaps comes in more hawkish than expected at his testimony. Generally speaking, right now, we have the euro sort of just in this giant consolidation wedge. While momentum is clearly still pointing negatively, we've seen the euro move back up towards resistance level around this 109 region. And for now, that's been where we pretty much have stopped going up. Although, again, it's going to be largely dependent on what we hear for the next 2 days or so, because clearly, if we were to get above this 109 region, there's certainly room to rise back to around 100 to 110 to the 111 area with the downtrend in place right here, while a failure to get above resistance certainly puts us back in the realm of potentially moving back down to this 107 area and potentially even this 106.95 area. If you get a Jay Powell that's more hawkish than expected, I think it also increases the odds that you're going to see the U.S. dollar break out higher versus the Japanese yen. We've just been really consolidating sideways now for some time. It still looks like there's a bull flag that's formed in the yen, but to this point, we haven't really broken out in either direction. I mean, clearly, if we were to break support at 149 3/4, it's going to open the door for a return back to 146 1/4 over the next couple of weeks. But I mean, at this point, the pattern still sort of suggests, and it still looks like it wants to try to take one more shot at this previous high around 150, 170, which also was the previous high back here in October of 2022. And then, of course, we also have the pound, which hasn't really done very much against the dollar either. You've just been seeing it consolidating really sideways. It looked like we were going to get a break lower, and then we snapped back, and now we're back at the upper end of the range at 127.35. So until we really see some sort of meaningful movement, I think you're just looking at these range-bound currency pairs. And honestly, I think one of the reasons why you're not seeing any movement is because you're not really seeing rates in the U.S. moving. Despite all the hotter data, you really haven't seen the 10-year move up. It's kind of just failed after multiple times of trying to get above the 433 to 435 area. And it could just very well be that the market is waiting for what Jay Powell is going to have to say when he speaks in front of Congress. Because I guess if he comes out and he's more hawkish and he's talking more upbeat about the economy doing well here in the U.S. and he's talking more about, inflation taking longer to get back to target, it could be a reason for the for rates to really rise. And obviously, if he's talking more dovishly and talking more about the economy potentially slowing and inflation coming back to the 2% target and the need to cut rates sooner than what the previous view has been, then obviously you're going to see the 10-year break below support at 410 and potentially begin to move back down to this 390. Where, again, a more hawkish Powell probably leads to a breakout back to this 470 region, and that's going to certainly lead to, our currency pairs all showing signs of dollar strengthening versus the pound, dollar strengthening versus euro, dollar strengthening versus the yen. And even when we look at the 2-year, that's also stalled and going higher. We were talking about the potential for the 2-year to break out and move up to this 495 area. The 2-year is actually broken the other way, despite some of the data coming in a little bit hotter than expected. So, at this point, again, we're looking at support at this 450 area with the potential for a return to this region. Obviously, if you get a more hawkish Powell, you're going to potentially see a retest of this 4 3/4 area. That could potentially lead to that breakout back to 495. So I think you have to listen very carefully to what he has to say tomorrow, and specifically how that jobs data comes in on Friday, because again, a hot jobs report's also going to get a lot of these is also going to help the strengthen dollar, push interest rates higher, while a weaker than expected job report is going to do the opposite. When we swing over to the NASDAQ today actually gapped below a rising wedge. It came all the way back down to where we were basically on the last time we spoke on February 28th. And we actually got below that level, and then we're able to manage to sneak back above the 17,850 region right before the close. But I think what's important here is that, number one, this technical pattern has broken, and that does suggest that there could be further downside here in the NASDAQ. I mean, at this point, we've retraced just a little bit more than 50% of the rally, and that doesn't really seem like the ideal place to stop. I would have thought, if you were looking for some place to bounce, you would expect it to either have occurred at the 38.2% retracement level or at the 61.8% retracement level. So I think that I think it leaves open the chance and the shot for us to revisit this gap and refill it at 17,450 and erase the gains that we had post NVIDIA. Likewise, once we form gaps, you have to always assume that the potential is for the index to reverse and to refill the gap at some point down the road. So at this point, we have two open gaps, one at 18,250 and one at 17,450. And so it would seem like where we go seems to be one of these gaps. But again, I think that the breaking of this patterns is more suggestive of a completion back to this gap fill at 17,450. And I think longer term, we have this really big broadening megaphone pattern, which is also in play. And that really puts a lot of emphasis on this 17,450 gap, because if for some reason we were able to move below this, it would potentially break this pattern and set up something a little bit steeper. You can see we've already had 1, 2, 3 touches at these levels and just 2 touches here. So we would be looking for a third touch here. And so this seems to be like a place that we could potentially be targeting over the near term. The S&P 500 also had a rising wedge pattern broken today. We can see that the S&P 500 was able to retrace a little bit more than 38% of it. Again, this doesn't seem like an ideal place to stop. We basically were able to find some support right around this 5,060 region. Again, really not being able to meaningfully move below it. So we're looking right now, if we were to gap lower tomorrow and take out 5,060, I think that opens up the door to this fill back here around 49.80 to 49.50. Again, I think if you get Powell speaking a little bit more hawkishly or sort of pushing back on rate cut expectations, it could start to tighten financial conditions. And as financial conditions begin to tighten, that's really what is going to be the driving force in terms of where stocks go. Obviously, again, there's a gap up at 51.35 that still needs to be filled from today's movement. And also, it's not unusual sometimes to see these rising wedge when they do break, come back up to the trend line and retest it. But again, more likely than not, I'm sort of thinking that we're going to start working to fill these gaps because they've been left open now for some time. And typically we see these gaps get filled over time. And finally, when we look at the Dow actually already filled its gap from the 22nd. We can see that it kind of just stopped right here, really in no man's land. And we're going to want to see basically, again, how this sort of plays out, because the Dow has been the laggard out of the S&P and the NASDAQ, mostly because it doesn't have NVIDIA in it, right? While it still has many of the other tech components, it doesn't have that one stock that's really been sort of the driving force in a lot of the rally. And so you've seen, it will be interesting to see if more weakness develops in the Dow. Clearly this area, this region, it's this 38,400 to call it 38,500 area, could be an area where you find some support in the Dow with a break of this, certainly setting up a drop back to 38,055. Again, there is this open gap up here at 38,990. You can see today that we gapped below this support level that I had in place, and basically just continued to drop in a straight line all day with really not much relief, just coming in basically the final, call it 30 minutes of trading. And so the market has had a really big move overall, and it hasn't really had very many pullbacks. And so, the conditions are there so that if the market wants to see rates push higher, if the market wants to strengthen the dollar and begin to tighten financial conditions overall, the conditions are right for a broader equity market pullback of some size. Again, largely going to depend on what the data is and what Powell has to say, and even what Lagarde has to say, because if Lagarde somehow comes out and she gets the euro strengthening versus the dollar, it could also sort of impact things as well. So just a very important time to be paying very close attention to all the details, because again, what's said and what the data shows is really going to determine, I think, which way this market breaks, probably for the balance of the month of March. Anyway, have a great rest of your day, and we'll see you soon. Bye.